Power on.
So two sections here. So the first section here is how are stocks bought and sold. Um, so to buy and sell stocks, the first thing you have to do is set up an account, which is as simple as opening a new checking account. You can set it up at a full service broker, a discount broker, your bank, other financial institutes. So you need this account that's set up for buying and selling stocks. Um, Typically, it's like opening a checking account. You need your social security number, your identification. Um, you'll get statements from your account showing what goes in and what comes out. Oftentimes, you can access them online. Um, so you get your account set up, then you place transactions. There are four types of transactions, which are called orders. A market order is a request to buy or sell a stock at the current market price. So you would just tell, if you're going through a stockbroker, you could say, I want to buy 50 stocks shares of this, or you could say I have $1,000 to spend on stock XYZ, and they would buy as many as they could just at the price it is that day, or at the time. There's no guarantee of what you're going to pay or receive if you're selling. A limit order is a request to buy or sell a stock at a specific price. So if you're buying a stock, it guarantees that you'll not pay more than a set dollar amount. And same thing, if you're selling, it guarantees you'll get at least this much money, a specific dollar amount. So say, for example, you tell your broker you want to buy this stock XYZ when it drops to $40 a share. If the price doesn't ever go to $40 a share, your broker would not buy it for you. Even if it goes down to $41, unless you changed your order, you wouldn't purchase it. And same thing with selling. You could say, I want to sell this as soon as it hits $40. If it's only $39, they're not going to sell it for you. A stop order is a request to sell a stock when it reaches a certain price. The same thing like that limit order, you wait for it to get this certain price. It protects you from a sudden drop in price. And it allows you to capture profits when a higher price is reached. A discretionary order is an order to buy or sell a stock that allows the broker to get the best possible price. So basically, you're giving the broker discretion. They get to decide what they think is best. You could say, I have this $1,000. I want to buy stock XYZ. Please invest it when you think it's best. Likewise, you could tell them, hey, I want to sell this stock. Sell it when you think is best. So you're leaving it up to the broker to use their best judgment. And it doesn't mean they're going to be correct. It could continue to go up or down. No one ever knows. That's kind of the problem with stocks, or the risk, I should say. So if you want to place a transaction, you have these 4 types of orders, and then you take action. Here are kind of the steps. So if to buy a stock on the New York Stock Exchange, the investor would take these steps. So the investor, that would be you, contacts the broker and asks him or her to buy shares of stock. So you call your broker, you email him, whatever, you say, I want this. They relay the message, that order electronically to the clerk at the stock exchange. The clerk gives the message to a floor broker. The floor broker goes to the trading post at which the stock is traded. So there's the different posts for the different stocks. The floor broker negotiates a buy from the floor broker for the stock being sold. After the trade is made, the floor broker relays a message to the clerk and to the consolidated ticker tape. The sale appears, the confirmation is sent to the broker notifies you, the investor. And if you go look at your account, then it shows up on your account. That reflection is made. So basically, you're only involved in step 1 and then 9 and 10. You contact your broker, and then at the end, when it's done, they let you know, and you can see it in your online account. Just basically in here, it shows there's a lot of middlemen and a lot of steps it kind of goes through in this. That's one of those option markets, though. All right, so when should you buy or sell? So that was kind of how you do it, and then when should you do it? So you can use cash. So cash doesn't mean you actually have the dollars in your hand. It means you have that money available in the bank to invest it. That's what I recommend. You can use credit if you don't have enough cash to make the purchase. You can leverage it or borrow the money. This is very risky. I'm not a huge risk taker, so this is not my forte. It's not something I recommend, but again, that's my personal opinion. A lot of people do it, hence why there are terms that go along with it. So basically, you borrow money to make the trade. So selling short is selling stock that has been borrowed from a broker and replacing it at a later date. So it's very risky because your losses are unlimited and the stock price could go up indefinitely. So with selling short, you're hoping to buy back the stock at a lower price than you sold it for so that you make a profit. So you are betting that the stock prices will drop. If they don't drop and they continue to rise, you're going to lose money because you still have to replace that borrowed stock with stock that you have to pay for at a higher price. So selling short is you're anticipating that the stock is going to drop. Buying on margin is borrowing money from your broker to buy stock. So it's like taking out a loan. It's also very risky because if the price of the stock falls, it will trigger a margin call from the broker, meaning you must put up additional cash or collateral on the loan to avoid default. So basically with a buying on margin, so again, you're borrowing money like a loan from your broker. You sign this margin agreement, which has some sort of collateral with it, meaning if you can't pay your loan, this is what they're going to take. And it could be the stock. So when you're buying on margin, you're betting that the stock is going to increase in value so that you can sell it and make a profit. That's what you're hoping for buying on margin. However, if the stock price goes down and you were buying on margin, hoping it would go up, you still have to pay that loan back as well as any possible interest on that loan. So here's an example of that. So this is a buying on margin example. Marco invests $5,000. So he has $5,000 cash and he borrows $5,000 from a brokerage firm at a 5% interest rate. So now he has $10,000. He buys 500 shares at $20 per share. So that's all $10,000. And he uses the stock as collateral for the loan. So if he's unable to pay it, they're going to take the stock back from him. So 6 months later, the stock has increased to $30 per share. So he sells all of it. He had 500 shares, so he gets $15,000. And then he has to pay the broker commission and fees of $150. Okay, so again, he had 10,000, he had 5,000, borrowed 5,000. So he invested 10,000. He sold it and got 15,000, but he paid a fee of $150. So that brings us to the top of step 3. So his proceeds are $14,850. So he repays the $5,000 loan, plus he had to pay $125 interest. So it was $5,125. So when he now has $9,725. He originally spent $5,000 of his own money. So he made $4,725. So again, this worked out well for him. But it's not all the time that in 6 months, the stock is going to go up, $10 a share. And when it's $20 for a share, $10 a share is a lot. That's half of its value. So it went up by 50% of its original value. So again, there's at the bottom there's no guarantee that the stock price will rise. If the stock price had dropped, Marco still has to pay that interest on the loan. So he still has to pay that back, that $5,125, no matter what. So if the price had dropped when he sold it, he's going to have to pay out of his original $5,000. So again, buying on margin, you're betting that the price is going up essentially. All right, so then what are buying patterns? So there are 3 different buying patterns here. Buy and hold is a plan to purchase and keep stock for the long term. So you can make money 3 different ways. You can receive cash dividends. You can assume that the price, or hope, I should say, if the price goes up in the long term, then you're going to have capital gains when you sell it. We're not talking a year down the road. This is long term. Or another way to invest or make money off of this is you could, for buying and holding, have stock dividends and stock splits that we talked about yesterday. So you get more shares of that stock, which then when you go to sell them makes you more money. So buying and holding, you're holding on to it for the long term. You don't plan on selling possibly until retirement. So, you know, it could go up and down 50 times and it doesn't matter to you. You're just holding on to that stock and hoping for the best. Stock turning is a strategy of making regular and systematic changes in stock ownership based on trends in the economy. So that's for people that are following it closely, and maybe you have a stockbroker doing it for you. You know, it could be monthly, it could be quarterly, it could be more often, depending on what's going on. So you pay attention to what's going on in the economy and different trends and make your transactions based on that. Watch and wait is when you select securities. So you decide what you want to buy and you prepare a comparative analysis periodically. So every 2 to 3 years, essentially. So it compares how investments have done since the last analysis. You may also compare your current choices to other possible choices. So maybe you kind of have a list of all the ones you're interested in. When the analysis is complete, then you decide what you want to do. So maybe you don't have the money to invest yet and you want to watch and wait. You want to see what's going to happen. So that's an option. And then managing your costs. So there are costs associated with buying stocks or securities in general. The commissions, the fees, and you're going to want to minimize what comes out of your pocket in those terms. So if you use direct investing, remember, you don't use any sort of broker or anything. You basically save all those fees, but you have to do all of your own research. And then same thing with the reinvestment strategy, you can avoid some of those transaction fees as well. So types of transactions, there's a round lot, which is exactly 100 shares or multiples of 100 shares of stock. So you could buy 400 shares or 4 round lots. An odd lot is fewer than 100 shares of stock. Brokerage firms usually charge higher per share fees for odd lots. So if you could afford 100 shares of a stock, you may save yourself money in some of those fees. And then using discount brokers, they usually charge a flat fee per transaction, which may save you money. And then timing and combining. So you can, as an investor, you can also save money by making all of your trades at once rather than at different times. So again, timing and combining, you do it all at the same time so that you save on those transaction fees. All right, that was all of those slides for today.